8 ways to recognize the value of a stock, based on science. Stocks are one of the most popular investments. If you're thinking about buying stocks, there are some things to know before you invest. Stocks are priced based on supply and demand. The price of a stock will change depending on how much people want to buy or sell it. There are other ways to identify stock value. Watch more to find out. Why buy stocks? Stocks are a great way to make money, but they are not for everyone. The value of stocks can go up and down. If you buy stocks, you may lose money. You should only invest what you can afford to lose. But if you do want to buy stocks, there are lots of ways to weed out the bad ones. There are other ways to find out if a stock is worth buying too. Keep watching. Recognize the value of a stock. So how do you recognize the value of a stock? What are the best way to understand how it is priced? There are 2 things to know about how stocks are priced. First, supply and demand. One way to recognize the value of a stock is the supply and demand. A stock's supply and demand are based on how much people want to buy or sell it. If people want to buy a lot of a certain stock, then the supply will rise. This means that there will be a lot of buyers, and they'll have a lot of choices. There won't be many people selling that stock, because they think it's going to go up in price. On the other hand, if more people want to sell a certain stock, then the supply will go down. This means there will be fewer buyers, but there will also be fewer choices for them. There will be many people selling the stock, because they think it's going to go down in price. Second, price-to-earnings ratio. A price-to-earnings ratio tells you how much money a company makes with how much they're worth. Remember, a price-to-earnings ratio of 10 means that for every $1 the company earns, the company is worth $10. How do you find out if a stock is good for you or not? One way you can tell if a stock is good for you or not is by looking at the company's balance sheet. The balance sheet shows how much money is in the company's bank account and how much debt the company has. A company with a lot of debt is considered risky because they owe money to someone else. Another way to tell if a stock is good for you or not is by looking at how volatile it is. The more volatile a stock, the more likely it will go up and down in the future. It's risky because it's hard to know when its value will change. Also, look at the company's earnings per share, EPS. This is how much money the company makes per share. What are the different ways to recognize the value of a stock? Some other ways to know if a stock is good for you are: 1. The company pays a dividend. This means that a portion of the company's earnings is distributed to shareholders in the form of a dividend. 2. The company consistently pays its dividends on time. 3. The company is profitable and has been profitable for at least 4 years. 4. The stock market has not fallen sharply in the last year. 5. The company is not in a negative industry, like coal mining. 6. The company is paying down its debt and not taking on more debt. 7. The company has a high return on equity, ROE. 8. The company has a low price-to-sales ratio, PSR. 9. The company has a low PE ratio and price-to-book ratio, PB. 10. The company pays out dividends that are higher than the average in the industry it's in. 11. The company pays out dividends that are higher than the average for all stocks in its industry group. Price-to-earnings ratio. When buying stocks, one of the most important things to know is the price-to-earnings ratio. The PE of a stock is how much money a company makes for every $1 they're worth. The PE is used to compare how much money a company makes with how much they're worth. So if a company has a price-to-earnings ratio of 10 and makes $100 in earnings, it's worth $1,000. If you're interested in stocks that are priced higher in value, you might want to pay attention to the PE ratio instead. Dividend yield. A dividend yield can tell you how much money you'll get back from the investment the company paid out to their shareholders. It's calculated by dividing the dividend by the current stock price. A dividend yield of 1.5 means that if you buy $100 worth of stock, and the company pays a $15 dividend, you'll get $75 back. This is a good way to make money from stocks, because you get the dividends, and the capital gains, or the increase in the stock's price. But remember, not all stocks pay dividends, and not all companies pay dividends regularly. Some companies keep all the money to reinvest in their business. Price to sales ratio. The price to sales ratio, PSR, is another way to measure the value of a stock. This ratio is the price of the company per dollar of revenue. For example, if a company's stock costs $500 per share, and they made $500,000 in revenue, the PSR would be $1. But the PSR doesn't necessarily tell you how much money the company is worth. If a company makes $100 million in revenue, but their stock is only worth $2,000 per share, their PSR would be $50. The price to sales ratio is also called the price to earnings ratio. But PSR tells you how much a company is worth in terms of how much money the company makes. But remember, this is just one way to find out if a stock is good for you or not.